Say that you purchase a single family home for $200,000. And let's also assume that you're going to make a 20% down payment, which would be $40,000. Let's also assume that you need $10,000 more for closing costs as well as reserves for a total investment of $50,000. Let's evaluate how these three financial benefits combine to form an overall 25% ROI on this property. Here are the relevant numbers that you need to be aware of. You got a purchase price of $200,000. You have a down payment of 20%, which is $40,000. You have closing costs and reserves of $10,000. So your total investment is going to be that $40,000 down payment plus the $10,000 for closing costs and reserves for a total of $50,000. We're also going to assume that your monthly rent, meaning what the tenant's going to pay, is $1,600 a month, and that your monthly mortgage payment is $1,000 a month. So your gross positive monthly cash flow is basically subtracting the $1,600 a monthly rent from the $1,000 mortgage, which leaves you $600 left over every single month. Now let's calculate the net positive monthly cash flow, because remember, $600 a month is a gross cash flow, but we're going to assume that there are $267 in expenses, and that might be for property taxes, property insurance, property management fees, repairs, or vacancies. So if I take my $600 a month of gross cash flow and I subtract out all of these expenses that at some point will come out, I'm left with $333 a month. Now let's calculate our ROI based on these figures. Number one, we're going to calculate the cash on cash ROI. Next, we're going to do the principal reduction ROI, and then finally the appreciation ROI. And if you add all three of these together, it's going to help you figure out what your total ROI is.